get started here. So good morning, good evening, good night, wherever it is. I'm Cameron Pfeiffer. I'm at the University of Oregon. I'm going to be the moderator today for Liyan Yang, who is here from University of Toronto. Just a reminder about the format here is we're going to stop about every 15 minutes or so for questions, and we'll turn it over to Liyan to answer those. If you want to ask questions, you can hit the raise hand button, which I believe is under reactions, depending on your version of Zoom. It could also be under participants. I'll call on you, or you can put it in the chat and I can read your question for you if you don't want to speak on Zoom. The meeting is recorded. Just a reminder, you should have seen the notification. And yeah, let's join me in welcoming Liyan Yang for his very interesting paper. So Liyan, you have the floor.
Thank you very much, Cameron. Thank you very much for the invitation. So this paper is information network paper. It's a co-authored with my long-term co-author Itay Goldstein, and also my former student Xiong. She is now working in Hong Kong UST. Both Itay and Liyan in the audience, and I think they can answer questions in the chatting room. After every 15 minutes, I can stop and we can chat. So the paper, what we do in the paper is to think about why people want to share information with each other in the financial markets. So kind of the incentive and also the consequences. If they share information, what will happen to their profits? What will happen to the market outcome, like price informativeness or market liquidity, this kind of things that the regulators and academia care about. So I'm going to give you two motivations. The first motivation is very closely related to our baseline model. And then the second motivation is related to our extended model. So both motivating examples is related to information network. So the first one is a very specific kind of example called the investor conference. So basically, a bunch of institutional investors, they get together and then they chat with each other. They present ideas and they talk about their investment strategy and what we have done, and then they try to share trading strategies. So we know this is more like a network, right? So it's kind of people try to get close to each other. But the question here we want to ask, so why they want to get together? So if they want to share information with each other, who will share information with who? So for example, who will stay on this podium, who will be in the audience? And if, so they stay on the podium, how much information they will reveal? And if they reveal information, what will happen to their profits for the people on the podium, for the people in the audience, and what will happen to the market outcomes? So that's kind of, we want to dig deeper into this question, not just simply say, okay, they try to share information with each other. We want to understand why they share information and who will share information with whom. So the results kind of very surprising after we developed the model. So we found the result is that when we try to share information, think about who will share information with whom. So probably the prior is the people who have more precise information will share people who have less precise information. If you denote H as people with highly precise information, and L with people is a low precise information, they might think, okay, there might be information flow from H to L. So actually what we found is the opposite. The information actually not from H to L, actually it's from L to H. It's kind of very counterintuitive. And after information sharing, so we also found that the information, the profit of information receiver, who is the H person, his profit actually become the lower, and the information sender, which is the person who had low information precision, his profit actually become higher. Now this is again kind of counterintuitive, because if you think about the partial equilibrium, a Bayesian person always will become better off if she gets more information. So, but this is not a partial equilibrium. Of course, all the results come from general equilibrium. But after you consider the interactions in the market, actually it's the opposite. Who receive the information actually will become worse off. Who send the information actually will become better off. So this is the second result. The third result, if you think about if the information receiver knows my profit will become lower, so I might want to commit not to listen to the information sent by the sender, because I know if whatever information you will tell me, I will become worse off. So whatever information you tell me, I will not listen. So that's more like a commit not to listen to your information will make me better off, actually. So that's true if you only have one high person. So we show that if you have multiple H people, suppose you have a lot of H people, so we found that actually in equilibrium, all of them will choose to listen to the information sent by L. So it's more like a presenter dilemma. They know that collectively by listening to information talking on the podium, they will become worse off. But actually, they don't want to deviate because that's more like a presenter dilemma outcome. So these are the three most surprising results implied by our theoretical framework. And then we use this framework to think about the implications for market. So for market outcome. So we find that the price informativeness will become higher, and the market liquidity will become worse off. So that's the trading volume will become higher. So that's kind of a general picture and a general result of what we have done in the paper. So this is the first motivation. Our model will kind of match quite closely to this setting, the investor conference setting. We have a bunch of institutional investors, they get together and we think about how they share information with each other. And this is our baseline model. And we also have extended model that can speak to the social trading. The social trading may be related to the recent phenomenon, the GameStop, but we don't want to claim our model is the only kind of story explaining that. There might be other kind of perspectives that can speak to this. So the social trading basically says some people, either institutional investors or retail investors, so they also want to kind of talk their trading strategies on social media. So like this person is an institutional investor. Hey, the hedge fund person, hey, the talking kind of Twitter, talk about what he had done over the past year, and then share his trading experience. This is about the institutional investors, social trading. And also have some retail investors. The most recent one is the GameStop, and the retail investor also talk to each other. So what they have done, and then maybe the GameStop idea is more like a coordination. So maybe not quite related to our paper, but our extended model can shed some light from a different perspective. This is more like an information perspective. So these are the two motivating examples. The first one is about the investor conference. Number two is social trading. And the three kind of most surprising result we found is the information flow from L to H, and the profit of L will become lower, profit of H will become lower, profit of the sender will become higher. And we also found that the present dilemma problem, if let a lot of H investors, they want to listen to the sender's information, although they know collectively they will become worse off. So that's kind of our broad motivation and our kind of finding. I think I already talked about this, the kind of what we have found in the paper. And also given the time constraint problem, I'm going to skip the literature. I'm going to move on to the model part. So now it's about 10 minutes. Should I stop to see whether people have questions? Cameron, you unmute. No, you're unmuted, but I cannot hear you.
Oh, crap.
Okay, yeah, now it's good.
Yeah, sorry. So I think I don't see any questions in the chat. I don't know if people have questions, if they want to raise their hands or anything. I don't see any. So I think we can kind of move on from here and we'll check back in when people have questions.
Okay, great. So that's the kind of motivation. Now I'm going to move on to the model part. So we take a very kind of parsimonious approach, or minimal approach. So we think about a very standard model, which is the Kyle model. So we always know that the standard Kyle model have three group of players. We have informed investors. Those people have information. We also have market makers. The market makers basically is a kind of reduced form of thinking about how the price is determined. And then we also have node traders. node traders don't have information. They trade for some liquidity reasons. These are three group of investors. We all know this. And in equilibrium, the market makers will break even. The informed investor will make a profit. Those people kind of will lose money. So this will make money, this will lose money. And what we do in the paper, so we just add one minimal element. We just allow some kind of informed investors, they talk to each other. We allow them to share information before they trade. So if you think about the model, so data 1 and data 2, that's the standard Kyle model. So here we have two informed investors. So one is H, the other one is L. H is the person who has very precise information. L is the person who has less precise information. Those two people are informed investors. They are institutional investors. And we also have market makers. We have node traders. They will trade on data 1. And on data 2, they will collect a profit. The economy will end. So that's a standard Kyle model. The only new element is on data 0. This is the only new thing. On data 0, we allow H and L, they talk to each other. So we allow them to share information before they trade. So we either H tell information to L or L tell information to H, and they can tell basically what information they have and how much information they will share with each other. So we will determine so this is a new element to the model, very, very parsimonious, and also very standard. So this is the model structure. So now let me move on to the specifics. That's a very risky asset. You think about the risky asset as a stock or as a bond, so anything risky. So it's a normal distribution with mean 0, precision 1. So this is normalization. So the normal, we know the in Kyle model, normality is important just for tractability, but the kind of the mean and the variance is irrelevant. It's mainly normalization. And I said we have two risk neutral informed investors. One is H, the other one is L. And we assume H sees the fundamental value of V perfectly. Basically, his precision for the information is infinity. And L will see V plus an error term. The error had a precision rho. So now you see H is more informed than L. And later on, we will extend the model to kind of allow H also observe noisy signal about the V. But now it's more like a very extreme case. So H sees very perfect information. L sees kind of noisy information. So from the perspective of our predicting fundamental, L's information is useless for H. So since H already knows the V perfectly. So this is the information, private information of H and L. And H will share signal with L according to this function form. Basically, his signal plus some error term. So this error has a precision tau H. And L also share his information with H is Y plus another error term. The error term has a precision tau L. Tau H and tau L will be the precision. So how the kind of determine how precise the information shared information is. When tau H is the infinity, so H tells all his information to L. When tau L is infinity, also similarly, so L tells all his information to H. So this tau H and tau L will be the choice variable. So they will choose tau H and tau L to maximize their profits on data 0. So that's a Nash equilibrium. And in data 1, so people try to maximize the profit. For H knows his private information V. He knows the shared signals. He get a signal from L as L. He also knows the signal he sent to L as H. And so basically SH and SL is the public information among H and L. This is small group. That's the investor conference. They share the information in the conference. And they also know their private information. They will trade on the information set to maximize the profit. And we also have node traders. Node traders is standard normal with mean 0, some precision. And the market maker again set the price according to this weak efficiency rule. So this is basically the standard Kyle model. So this XH is the order submitted by H, XL is the order submitted by L. This U is the node trader. So this is the model setup. The only new element you see that is this part. It's the only new element. Basically, how much information H and L will share with each other. We will try to determine the value of this tau H and tau L in equilibrium according to a Nash game, a Nash equilibrium. Okay, now let's think about how to interpret that information structure, the information sharing structure. So you can think about the information sharing as a sharing data set. So I'm going to take L as an example. Suppose L has information which is given by a data set. For example, so L is conducting some survey on the product of the firm's product. So each survey is about a consumer. The consumer's view will be a noisy signal about the fundamental value of the firm. So the fundamental value is V and plus a common error. That's kind of specific to this survey approach. When you do a survey, maybe it's because it's all about the consumers, about the one product. So that's a common error term. It cannot perfectly reveal the fundamental value. So this noise is related to the consumer. So each data point, each survey is a statistic, is a signal about the fundamental value. So this is given by this. Suppose this person, this L investor had conducted a lot of surveys, collected a lot of data points. And so all the data points basically to L investor is a sufficient statistic given by the weighted average of all the data points. That's essentially it's a V plus the error E term. So that's the signal owned by an L investor. And the L investor can determine how large, how many data points she will share with H. So suppose she's going to share a subset which has a size TL to the opponent H investor. And we can show that the sufficient statistic for that signal is given by the weighted average of the data points. And that is equivalent to the original signal owned by investor L plus the error term. So this error, the precision is related to the data size. So data set size. If you share more data points with H, so the precision will be high. So essentially what I'm saying is you can interpret that tau H and tau L as the size and the number of data that the investor want to share with each other. So you can, that's kind of interpretation of that tau H and tau L, an empirical interpretation. So this is the model setup. So now I'm going to talk about the key mechanism. So why H investor want to hide information from L, but L investor want to share information with H. So all the results are driven by a single mechanism. The mechanism is the investors' trading incentives, how they trade against the information, share the information. So specifically, in the trading game, so this is the investor A's order, the trading strategy, this investor L's strategy. So we consider linear strategy. So their order flows will linearly depend on their information. So for investor H, he had a private information V, public signal between H and L, SH and SL. So those alpha will be endorsed coefficient, kind of trading sensitivity of investor H to her information. So similarly, beta also the information sensitivity of L investor to her information. So the interesting part is H will trade against the information shared by L. So this is the key part. So this alpha L endogenously will be negative. So this is the mechanism that drives all the results, because H investor will trade against on the information shared from L. So the intuition is the following. Recalling this extreme example, so H investor knows the fundamental value of the asset. So H investor knows V. So V is the fundamental value. And H, suppose L tells the information, her information is given by V plus the error. Suppose even L investor tells everything to H. So H does not need to use the information from L to predict V, because she fundamental value V. But she knows that the information in L's signal has some error term. So this is the error E. So H basically knows L is stupid. L will treat on error. so H will treat against this error. So basically, H knows, okay, in this information sent by L, I know that error term, which is E. So E basically the Y minus my information V. So this is the error term. So when the error is high, I know the fundamental value is low, I'm going to trade against error. I'm going to sell this asset. So when the error is weak, I know the it's irrelevant to the fundamental value, I'm going to buy because I know L investor will trade against this error. So this is the key result. Basically, H can back out the error shared from L investor and trade against this error. In some sense, to H investor, L investor more like a node trader. So H want to trade against node trader and take the advantage of L. So that's why this signal, this sensitivity, this coefficient is negative. So from this perspective, if it's a partial equilibrium, H will take advantage of L because L is more stupid than H. H will trade against L, so H can make more profit if it's a partial equilibrium. But L can tolerate that. L know that I'm more stupid than H. I also know that H will trade against me and take advantage of me. But the point for L is to make more money from node traders, not from H. And the incentive for L to share information is I know that H will trade against me, but that's good for me because you think about L's incentive. L care about the market depth. So when the market price is very sensitive to L's information, L cannot make a lot of profit. For example, if the L knows the fundamental is good and the current price is low, when L want to buy, the market maker will adjust the price immediately up. So that will harm L investor. So if L know when I buy, somebody is going to sell, the market will not adjust a lot because the total order flow is not very sensitive to my information. So based in that sense, H trading against L provide a cover, try to hide L's order flow. So provide a cover from market maker. So L knows I am taking advantage by H investor, but that's also good for me because H covers my trade so that the market maker cannot detect my information. The market price will not adjust a lot. So as a result, I can make more profit from the more stupid people, which are node traders. So that's kind of logic. So L want to share information to H because he knows that H will trade against his order flow. As a result, the market maker cannot detect the trading of L investor. The price will not adjust. So L can get more profit from node traders. So that's kind of the incentive for L investor to share information to H. So it's all dependent on this negative sign. So I know somebody, if when I tell information to her, she will trade against my signal. So that's kind of the intuition in words. So next, I'm going to give you some mathematical results of why this is the case. I'm going to try to give you two mathematical derivations. The first one is if you just look at the objective function of L investor trading, it's already very intuitive. Recall that what L investor does is L knows her private information, and also she knows how much information she's going to tell opponent H, and she tries to maximize her profit. The profit is given by her order flow multiplied by the fundamental value minus the price. And the price is given by lambda multiplied by the total order flow, H plus L and plus node trading. And since the node trading is on average is 0, so when take expectation, I just ignore that part. And this one is the order flow order flow submitted by H investor. And this L investor order flow. So L investor will choose XL to maximize her own profit. And recall that what I said in the previous slide is this alpha L is negative. So when L investor tell her information to H, so this coefficient alpha L is negative. And you have a negative sign here, a negative sign here, this negative, this negative. And you can immediately see that mathematically, that will become a positive. So when I tell information to you, you trade against me, that will increase my intercept, making my kind of profit, capital gain or higher. So that's an objective function, even if all the other things don't change. So that's good for me. So I want to share more information with you because you can trade against me, increase this intercept part. So, and if you take the first order condition, you choose tau L to maximize L invested profit. So there will be 4 effects working through the endogenous parameters. So if that will change the market liquidity, that will also change the coefficient of the H investor on her information. So all these 3 elements all negatively affect L's investor profit. So only the first one, only the effect on that since negative coefficient is positive. So that this is the kind of formal proof. It turned out this effect is so strong that it will dominate, make the first order condition of the positive, that will push the equilibrium kind of a corner solution. The equilibrium tau L is equal to infinity. So that's kind of the formal proof for our result. This is the K mechanism. I hope I make the mechanism clear. So maybe I stop here and see. So I saw a lot of questions in chat.
Yeah. I think there's 2 that are kind of interesting that you can muse on. I think Jan got to most of them, but so I think Sabrina's question was, what are the incentives to manipulate the information you share, right? And I think in this kind of setup, they're like, it's not obvious that there's like a way for them because they just choose the amount of signals. But have you guys considered some kind of manipulation incentive for the low informed guy?
I don't think so. I think now it's more like honest information sharing. It's kind of choose how kind of the precision of information. I don't know. So what's the exact definition of manipulation? I'm not sure whether the definition of manipulation. So here it's not like I think the manipulation concept that we commonly think about. So the like information is honest. Yeah.
You like, let's say that you lie about like your mean signal or something, right? In order to...
No, we don't allow lying. So everything is honest. Yeah, so that's a truthful reporting basically.
Sure. Okay. Yeah. There was another question from Peter Sorensen, which is about what if the low types information becomes available to the market maker?
Yeah, that will be our extension. Yes, we will consider that one to think about the
Okay, gotcha. Yeah. I also kind of wanted to like think about the framing here a little bit too. Like the framing here seems to be in some sense that that H profits from L. But that isn't like my takeaway. My takeaway was like that L profits from H, right? Because L screams really loud about this this signal, and the high type is like, oh, okay, well, I guess I'll just, that's noise, I'll fix it. And in the end, the low type is the one that comes out as the victor, right? They're screaming and they get this higher profit relative to the baseline case where there's no sharing. Like,
yes, that's the equilibrium. Yes, if you think about if you think about the motivating here, so we want to see, we want to predict. So who will talk here? So those people, according to our prediction, actually they have some information, but not very precise. Actually, who's sitting here wiser or smarter than them, but actually in equilibrium, their profit become lower. Yeah, so there's a lot of involvement. So many layers.
Yeah, I think that's a very cool finding, right? That if you're loud and kind of dumb, you do better than the people who have really precise signals. That's cool. I like that.
Thank you. Yes, it's anyway. It's exactly. It's a lot of counterintuitive things. So we, because our prior probably is who speak up on the podium will be kind of more informed.
Okay. I think that's good. We can continue from here. And just to let you guys know, the audience, you can raise your hand and we'll call you when we get to the question point too, if you want to ask your questions directly. Okay, thank you.
Okay, so now I'm going to talk about implications. After that, I'm going to talk about some extensions that are relevant to the questions asked by the from the audience. So the first one is about the profits. The profits, we think about a benchmark without the information sharing. That's basically the Kyle model, standard Kyle model. We think about so now we add one stage, which is the data zero, allow H and L talk to each other. And if you consider equilibrium, so who will become better off and who will become worse off? As I said, actually in equilibrium, L investor will become better off, H investor will become worse off, and overall their profit will become higher. So the reason is the market liquidity, because the market liquidity will adjust. So although market maker don't see the information in our baseline model, the market maker know that H and L, they talk to each other. So as a result, the overall private information in the market order, in the aggregate order is higher. So the market maker know that they will face a more advanced selection problem as a result, because it's more private information shared between H and L. So market maker will adjust the steepness of the price function. So the market liquidity will become versatile. Basically, this lambda, cost lambda will become higher. So that's the key result, the key reason driving the profit result. Intuitively, you think about this. Intuitively, so before information sharing, H and L, each of them kind of take some market share and get some profit, and they take advantage of node traders. But L trader, overall their information is less precise than H. So their market share is small, relatively speaking. So their market share is because they have less precise information. So when market liquidity becomes worse off, so the market liquidity effect on L trader is not as large as the effect on H trader, because the majority of profit will go to H trader. So the market liquidity, the lambda effect will be very, very huge, very, very large on on H trader. So when market liquidity becomes worse off, H investor total profit will become lower. So become lower by 4% in this example. So suppose we set rho is equal to 1, market liquidity, node trader volatility is equal to 1. So H traders total profit will become worse off by 4%, but the L trader total profit will become larger, and the overall profit will become high. So that's kind of the result, the overall picture. So it's driven by the change in market liquidity, because H traders profit accounts a larger share in the market. So the effect of market liquidity on H is much higher than the effect on L. So when the general equilibrium effect kicks in, H investor will be more affected. So that's the kind of profit implication. And we also think about the kind of the other implications, like price efficiency. This is kind of intuitive, because the market efficiency becomes higher, or price informativeness will become higher after information sharing, because these two investors, they share information with each other. So that's allow more information incorporated into the price. And I said the market liquidity will become worse off, and we also can find that the total trading volume will become higher in this model too. So that's the implications for market outcome. So now I'm going to talk about some extensions. I'm going to focus on, so in the slide I covered 4 extensions. I'm going to focus on 3 of them. The first one, in the baseline model, we assume H investor observe the fundamental value very perfectly. L investor see some noise signal, and we in the first extension we allow both of them to see noisy version of information, or noisy version of signals. We will show the result will go through, and we also identify that the trading against the shared information, that the channel is the key driving the result. And also we consider multiple H investors, and we also think about the endogenous information acquisition, and we also think about that the market maker can observe the information shared by H or L. I'm going to focus on number 1 and number 2 and the last one. So the first one, the mainly for robustness. So specifically, so we think about these two investors, we will see know the signal about the fundamental value. So investor I see fundamental value V plus error. So this error had preceding rho I. So in the baseline model, you think about the rho H is equal to infinity, rho L is equal to a finite value rho. So that's the extreme case basically. So now we just allow these two investors had any kind of precision their information. And we think about when they will share information with each other, if they share, who the information will flow to whom. And when these two investors, their information is close to each other, this is the result. Then this is in the 45-degree line. This 45-degree line, basically rho 1 is equal to rho 2. So their information are is close to each other. So when the information close to each other, they will not share information with each other. So so basically, both of them will keep silent. In this case, you will find that in equilibrium, tau 1 is equal to tau 2 is equal to 0. Basically, so they don't tell any information to the opponent. So and we also found in this case, actually, suppose they share information with each other. Suppose to say 1 tell information to 2 as 1. We found that actually investor 2 will also trade on S1 in the same direction as what investor 1 does. So basically, they compete with each other. If you think about the trading against the error, it's more like the H investor is providing liquidity to H somehow. It's providing cover for investor L. But if their information very close to each other, so they will trade in the same direction. They really compete with each other. They're not providing cover or hide to each other. And when their information is sufficiently different, for example, in this range, rho 2 is much higher than rho 1. So you can think about investor 2 as H, investor 1 as L. And we will see in this case, again, the information flows from L to H, from 1 to 2. And also, when 2 trade the information shared from 1, it trade against that information. So that's again that trading against the error mechanism is driving the result. In this range, the investor 1's signal is kind of higher than investor 2's signal. You think about 1 as H, 2 as L. So now the information will flow from 2 to 1. So it's a symmetrical case. Basically, the intuition, the result here is when their information is sufficiently different in terms of quality, there will be information sharing, and the information flow from the relatively imprecise investor, informed investor, to the relatively more precisely informed investor. So from L to H. So and also the mechanism is identical to the baseline model. The baseline model, we just have a very extreme case. One investor knows the signal perfectly, knows fundamental value perfectly. The other one has a noisy version. Okay, so this is the first extension. The second one, so now we assume we have multiple H investors. So the motivation is driven by the observation in the baseline model. The H investor profit will become lower. L investor profit will become higher. So as I said, so H investor now might have an incentive to commit not to listen the information sent by L. So even L tell the information to H, H might say, okay, I'm not going to listen to you. So I will make myself kind of deaf. So I cannot hear what you are saying. So that's kind of commitment. So we allow each investor to make a choice whether we want to make themselves deaf, even if they can listen to what L investor tells. If there are only one H investor, that's indeed the case. Of course, because he knows after she listened to what L told her, her profit will become lower. So that's in her best interest not to listen to L. But suppose you have multiple H investors, and we can show if you have multiple larger than 3, it turns out it's a present dilemma. So all of them, even if they are given the commitment power not to listen to L's information, it ends up that's not equilibrium. All of them will choose to listen to L's information, and they will stuck in that bad equilibrium. All of their profit become lower, and the L investor profit will become higher. So it's kind of if you think about the investor conference example, so you think about that one investor on the podium, that person, the information is not very precise. That L person, she want to tell people in the audience, you want to think about, okay, how many people will register the conference? How many H investor will register in the conference? So if you have potentially many H investors, so they will all go to the conference, register to the conference. But after register with the conference, their profit actually become worse off, become lower. This is the second example. It's about the kind of the about the profit if you have multiple a second extension if you have multiple H investors. So finally, I'm going to think about the information sharing to market makers. So in the baseline model, we only allow information sharing between H and L. So now we suppose information can also be shared to the general public. So more like a public disclosure or social investing. So the investor can tell her strategy to the general public. Everyone can listen to that. And now we add one additional element, which we call it kind of receiver noise. You think about the information sent by each investor. Say H send the information about his fundamental private information plus the error. So this error is the sender error. So when H investor sends her information to other people, she will add sender noise to the information, original information. That's her choice variable. But after receiver gets the information, the receiver will also add another noise. So noise for market maker at eta m. For L investor, we'll get so where is it? So it's L investor is here, yeah. Okay, L investor will get another error. This is kind of the receiver. This is eta m and eta L is the kind of the receiver error. You can interpret this as the investor sophistication. So even if they can get information sent by some information source, so it's kind of also depends on the receiver's ability to digest the information. If the receiver is very, very sophisticated, if they are working in the same area, both of them are quant funds, maybe they can understand better each other. If some investors are quant funds, some investors are kind of fundamental investor, so maybe that some communication area. So they will when they interpret the information, they cannot interpret the information precisely. So basically now there are two errors. One is the sender error. The other one is the receiver error. The sender error is the variance or the size of the sender error is determined, is chosen by the senders. So that's a tau H and a tau L. The receiver error is determined by investor sophistication. So when investor very sophisticated, so they can understand the information sent by the sender. So the error will be very naive. So they cannot understand. Even if they get the information, they cannot read the information, cannot interpret the information. So that's kind of the setting. So this sophistication is determined by chi, parameter chi. So in the baseline model, what we do basically, we assume market makers, they are very, very naive. So even if they get the information, they cannot understand the information. We basically assume the preceding for market maker is equal to 0. And for the infinite amount of receiver error added by market maker. And for H and L investor, so H and L investor, their sophistication is infinity. So they don't add any error to the information received. So that's the baseline model. Basically in the baseline model, we assume H and L, they are working on similar strategies in the similar area. They can understand each other much better. But for market maker, because they only provide the liquidity, they don't trade on information. Probably even if they get the information, they don't know how to deal with the information in the baseline model because they are doing different businesses. So in the baseline model, the market maker, basically the sophistication is 0. H and L investor, their sophistication level is infinity. They don't add any error. And we can extend the model as long the main result in the baseline model will go through as long as the market maker's sophistication is sufficiently lower than the H and L investor sophistication levels. So graphically, if you think about this XM, COM is the sophistication level of market maker. This XH is the sophistication level of H investor. So it's 45-degree lines, meaning that they have similar sophistication levels. So here above this 45-degree line, meaning H investors, because they are doing similar business as L investor. So for example, all of them are speculators. They trade on information, so they can understand each other much better. And market makers, because they only provide the liquidity, they don't understand the information, even if L investor tell the information to the market maker. So kind of in this 45, about 45-degree line, the result will go through. Actually, we don't have to be 45-degree line. So something looks like this. So the general idea is as long as the institutional investor, the H and L, their sophistication levels of understanding the information shared by each other, among each other, is much higher than the sophistication level of a market maker in digesting the information shared among institutional investors. So our result will go through. So I think that's kind of related to the question raised in the first part, when people talk about what if the information can be observed by a market maker. So we have to do some modification to think about that. And this one, we think the baseline model is we think it's very closely related to the investor conference example. So that's we think about the H and L are the market participants, the conference participants. So in this example, the extended model now, we think it's kind of probably related to social investing. So when some institutional investors tell the information to the general public, and only a few of them can understand the information better than the remaining will represent the market maker. So we think probably this is another perspective for us to think about social investing. And so that's kind of the third extension. So maybe I can stop here. I think I pretty much this is what I try to cover.
Okay.
I can talk about
Oh,
I can talk about it. I can talk about the concluding. I think I'm happy to chat about the question. So what we do, we basically think about a very, very parsimonious model. So basically just a Kaya model extended by one element to think about how investors want to share information with each other and why they share information with each other and who will share information with whom and what will be the consequences. The key mechanism is the key result is the information will flow from L to H from relatively imprecise informed people to the relatively more informed people. And the key mechanism is the H investor will trade against the information sent by L investor. So that's the key driving force, the mechanism. And after information sharing, the profit of H will become actually lower. The profit of L will become higher. So they might explain why those L people want to volunteer to talk. They are very interested in organizing investor conference because they can make more profits. And you can also understand why so Warren Buffett does not want to talk on the podium because he is the H investor. So if you want to talk to him, you have to pay money. It's not about the investor disclosure. It's information disclosure. It's more about the information sales. So it's a different story. And after information sharing, we also find that market liquidity will become worse off, price efficiency will become higher, and also trading volume will become higher. And if you allow multiple H investors, it turned out that those people will stuck in a present dilemma. So all of them will become worse off, although they know that if they deviate, they can become better off. But single deviating without coordination is not an equilibrium. I think, Cameron, I'm pretty much done. I can stop here.
Okay, thank you very much, Liyan. So at this point, we can kind of open it up to like general Q&A. So you can raise your hand, I can call on you, we can put it in the chat if you want to, but I think it's easier to just raise your hand. Okay, we have Josh Molnar, you can go ahead.
Sure, hi, thanks for the talk. Just a quick question. So you assume that L can commit in advance to how much they're going to garble when they share their information with H. So I think in your notation this was tau L. So I'm wondering if instead of this commitment assumption, tau L gets chosen only after L observes their signal Y. Do you know what would happen there?
Yeah, exactly.
And then
yeah, go ahead, Josh. Yeah.
Oh, and then I was also going to ask, what if you think the commitment assumption is kind of makes sense in this setting, or if you have a story.
Yeah, that's a good question. I think that's why. I think I have two kind of answers. I'm not sure whether they are kind of satisfactory. So that's why kind of we added this slide to think about this. We also thought about that. Indeed, we have a commitment. We basically assume exactly what you said. We assume information sharing is their private information, like H is private information plus some linear noise, and the noise is committed in its linear form and true to the precision. And then, so we gave this a practical interpretation like here. So you think about the information as data points, and if you can interpret this tau L as the size of that data sets. I think this is kind of more like a practical interpretation of how information is shared. But if you think about this back to the investor conference example, this may not be that relevant. This because it's not about the data point sharing. So we can also think about this more like a presenting that in the conference like here. So when this lady presented her strategy here, you can think about how much details she is going to add here. So and like how many slides she is going to cover. So basically, you can interpret our data points in that example as slides or as this line, each line. And that's kind of the match for the empirical relevance. But for theory, I totally agree with you. So that's kind of a different model, basically. So what we have now, sort of similar to the kind of information design, the kind of literature. So we have a commitment, and the commitment here is, but it's a linear signal. So what you suggest is after you see the information, expose it, depending on the realization, realize the value of V, how much signal I'm going to give you, how much noise I'm going to give you. So it's more like the error will depend on this value V. That's also I think that's theory wise that's different. We thought about that, but we don't know the result. Basically, that's a short answer. I'm not sure whether Itay and Liyan want to add more things. Yeah, I think theory basically okay. What we just argue is more like a Bayesian persuasion literature. We just assume this linear strategy, and you have the commitment power.
Okay, I think our next question.
Answer your question, Josh. Yeah, sorry.
Oh, okay. Peter's next up.
Okay, thank you for a very interesting presentation and paper. It was very enjoyable. I was wondering about this extension 2 that I kind of liked also, that both have some information and the thing about sharing it. But then I was wondering, perhaps you are, I mean, maybe the Kyle model you're building on is too linear in a way. It's kind of surprising that you go from saying nothing to saying everything as you cross a boundary. I mean, it would be nice if you somehow reveal part of what you have with some noise instead. I don't know if you have thought of any way of achieving that.
Yeah, so you are talking about this one, right? This is this slide. Yes, yeah. It turned out that mathematically it's always the corner solution. It's always the first order condition for the H person is always negative. The first order condition for the L person always positive. So it's always the H is quiet. L is very honest, telling everything to H. So what you have in mind is something like a partial disclosure, right? Partial sharing. And so in this model, it turns out not. Yeah, we probably a cheap way of doing that maybe is kind of adding a cost of sharing information, right? If you have a cost of sharing information, that will can give you a linear solution.
Thank you.
Okay, Bjorn, you're up.
Thank you. Thanks for a very nice paper, Liyan. I'm
Thank you.
definitely a low precision guy here, and I have a vague question for the high precision guy. I was trying to think about the time frame of the model here. So the investor conference feels like a rather slow forum for information sharing, and Twitter is probably much more high frequency. I was wondering if you can reflect a bit on if the model works fits the real world better in that high frequency or the low frequency world, and related probably most to the high frequency world. I was wondering how this is related, if at all, to sunshine trading. That when I announce my signal, you as a high precision guy, you can tell exactly how uninformed I am, and maybe in a way provide liquidity to me.
Yeah, great. Let me start with the second one. I think probably I have a better idea for the second one. So sunshine trading, this might be a very nerdy way of answering your question. So the sunshine trading, my understanding is so that's more like noisy traders disclosing their information, right? Because I'm not a toxic order. I'm a healthy order, so I don't have information. I trade with you. I try to kind of to show proof, to show evidence that I'm not a trader. I just need liquidity. So that's more like a sunshine trading, I think. But here in our model, those people actually are toxic order. I'm an informed person. I want to tell you, like for example, you think about the social investing motivation here. So they want to show they have this person want to show he had done a lot of good things to get a profit. So this motivate. This is not a node trader. He is a kind of informed person. But according to our model, he is an L person, not a H person. So I think these are different scenarios. Although both of them tell information to other people, but they are from different trading motive. The sunshine trading is from a liquidity trader. So liquidity trading in our model is totally passive. So our model is mainly from informed trader. So that's the difference between the mechanism. The first one about the high frequency and the low frequency, I don't have a good answer here. So I don't know how exactly kind of match our model to kind of this high frequency or low frequency world. And like my paper with Xiong is about high frequency trading. We also use the Kaya model, but that's also similar, like a very reduced form. So maybe here you can think about the market makers as some liquidity provided by HFTs. And so because they're specialized in kind of providing liquidity. And those investors, H and L, they might be fundamental investors. So they specialize in trading on information. It's kind of, but this link is very, very loose. So honestly speaking, I don't know how to exactly connect to high or low frequency. So yeah, or Itay, do you want to add something if you have additional thoughts?
I mean, I also kind of wanted to clarify a little bit about the sunshine trading thing, right? So that, from the high traders perspective, all the low types are noise traders, right? They have Gaussian errors and everything. So they perfectly match the description of noise traders, right? So
yes,
at least from the high types perspective, they're the low types are engaging in sunshine trading, and the high types are happy to provide liquidity, right?
Yes.
They're directly trading against the error. So like it seems like they're, it is an expression of sunshine trading, at least from the high types perspective.
That's observation is very interesting. Yes, if you elevate the model kind of to that level, I think that's a kind of a nice correspondence. It's like in the traditional sunshine trading model, the sunshine traders are node traders. They disclose the information to market makers. Market makers are uninformed. But they are better informed than node trader. Node trader trade for irrational reasons. They are purely noise. Now you can think about the H trader as a market maker, L trader as a node trader, right? So that sense, right? That's kind of a parallel between our model and sunshine trading. Yeah.
I think We're at the top of the hour here, so we'll just kind of like close the formal session. Liyan has agreed to stay on for a little bit more if there's extra questions.
Thank you very much.
But thank you everyone for coming, and I hope you enjoy the rest of your week. Okay, so looks like we have some extra questions. Oh, they're not jumping to the top here. I don't know who is first. I guess we can go. I think I saw Cindy's hand first. And it's jumping around. I can't see it. Cindy, can you just unmute yourself? I don't know if your hand's still up. It seems to have disappeared for me.
Yeah, she disappeared.
Oh, she's gone. All right.
Yeah.
Oh, were they waving their hands? Was that like a goodbye? Oh, see, Peter did it too. I thought he had a question, but I just have no idea what's going on. Okay, thank you very much. Cameron has been made the fool. All right. And so we can still answer some other questions if people have them. So, yeah, I don't see any. I think I think I wanted to comment on the title, because the title was interesting to me because it seems to kind of undersell the finding, right? It kind of makes this like it seems like it's okay, we're just giving this information to people who already have it, rather than the underdog is stealing from.
I think you made a good point there. I actually think that title misrepresents the point.
Yeah, I think our story or our finding is more like a drama. So it's because a lot of surprising things initially you thought about like this, and you are like a detective. The audience like the detective. You expect something, but they show you something totally surprising, and then eventually you say, oh, this is the culprit. This is the guy who should go to the prison. But you never thought about that. I think that a lot of kind of surprising things is constantly surprising us, the three of us, the authors. So we don't have a good. Maybe we should think about a drama title. We make the paper to make a paper into a movie. Think about the plot. Yes.
Yeah, I think I mean I actually really love this model because it's like a super clean extension to Kyle. You basically tack on some simple stuff, and it's like super clean, very interesting result. Like I think it's nice. So
thank you, Cameron. I have a comment on the format. Actually, I think for presenters, I think it's for me at least, it's better if you allow people to raise questions along the way.
I think we had some during, and I don't know, Jan was jumping into him, so you can blame Jan.
Because if you think about it, you in that way, I think I feedback from whether people which part people interested, which people lost. And now, so after 15 minutes, people probably forgot about the setting, and particularly for theory papers. If they have some comments, some questions, you have to hold till the break. But I think definitely for theory people, it's much easier for us to present and allow people to ask questions.
Okay. Yeah,
that's very good.
Right.
That's very good to hear, Liyan, because we've been trying to find balance here. We are worried that if folks are allowed to ask too many questions, then the presenter will never get to the end. But it's good to hear what you said.
Yeah, the presenter can control the flow, right? The presenter can say, okay, I'm going to, in the next 5 minutes, I'm not going to answer questions. It's more like a seminar, I think.
Yeah.
Okay, so I don't see any other questions. I think we can kind of conclude here unless people want to wave their hands again at me and confuse me.
Can I ask one final thing?
Yeah, go for it.
I agree on the drama interpretation. Also, you could have imagined starting from equally informed traders and think about their incentives to share information, and you wouldn't really find anything. So it's very nice also.
Yes, yeah. Basically, you're starting from that extension, right? Equally informed people, they will not share information.
Yeah, that was very nice.
Thank you.
All right. Okay. So I guess have a good week, everybody. Thanks you guys for coming.
Thank you.
Giving a round of applause for Liyan.
Thank you.
All right.
Thank you very much. Thank you.
Goodbye, everyone.
Bye-bye. Thank you.